Hey everyone, and welcome back. Today's video is going to be a breakdown and analysis of Facebook's second quarter 2020 earnings and results. So if you've been following the channel for some time, you would know that Facebook is one of my long-term investments. So I wanted to use today's video to demonstrate to you how I analyze a quarterly report for one of my long-term investments. If you were going to be investing into Facebook or any other individual company for that matter, then you need to make sure you're doing your own research and analysis and reaching your own conclusions. So when I make videos like this where I'm talking about a business in my portfolio and talking about my analysis, they can serve as a complement to your research, but should not be a replacement to the research that you do into Facebook or any other company. And the reason why I say this is applicable to not only people who are investing or looking to invest into Facebook is because you can see the process that I go through for a quarterly report. And you can apply that same process, that same analysis to any business that you're looking to invest in. And that is the way that I like people using this kind of content rather than using it as a replacement for doing their own research. But with that said, if you do enjoy today's video, I would very much appreciate it if you could leave a like on the video. That helps me out so much. And if you let me know your thoughts down in the comment section below, I'll be answering comments as this video goes live. But with that said, let's get into the video. The first thing that I'm looking at when a quarterly report comes out is the growth of the 4 key areas that we focus on that tell us about the strength, the core strength of a business. So these areas are, of course, revenue or sales, earnings per share, equity, and free cash flow. And when I'm initially analyzing a business, I'm looking for companies that can consistently grow over time at a rate of 10% or more, ideally. And if they're not growing at 10% or more, then at least there is consistency in their growth over time. And that's what I'm looking to see in the quarterly reports. I'm looking to see how their growth has compared in this quarter to previous quarters and over the past 5 or 10 years. With that in mind, we need to recognize that when we are looking at a quarterly report, we are looking at 1 3-month period out of a company's life that may be 10 or 20 years. So there are going to be fluctuations. There's going to be months and quarters where they perform poorly. There'll be months and quarters where they perform really, really well, and there will be many in between. And overall, they will add up to create an average that is more consistent over time. So you should expect to see fluctuations in this number compared to, say, their 10-year average growth rate. And that is particularly important to recognize when we are in such uncertain times as we're seeing right now. When economic conditions are weak, businesses are in such a different environment at the moment than they were just 6 months ago or 12 months ago. So that's something we need to keep in mind. It's kind of like the context of when you're analyzing a business. You should not expect that they continue to grow at 20% per year in this quarter because they've done that over the last 10 years, particularly because of the environment that we're in right now. So with that in mind, when there is a substantial difference in a company's growth rate in the quarterly report compared to, say, their 5-year average growth rate or the growth rate over the past 3 years, what you want to do is take the next step and understand why that has happened. And usually the answer is in the press release, in the quarterly financial results. Usually management will tell you what are the major factors that pushed that business around. And this serves 2 purposes. One, we can understand more about what kind of factors influence a business on a quarter-by-quarter basis. What are things that we should expect to see in the future, things that are just normal, that happen every now and then in the industry. And then we can also assess whether this is something that is going to impact the business over the long term. And that's what we're looking for when we notice that a company performs poorly, really poorly in a quarter, or even when a company performs really, really well. So for Facebook, let's start with their revenue numbers. So their revenue overall for the company, which is mostly made up of advertising revenue, that figure came in at $18.7 billion, which was up 11% year over year. Now, first of all, 11% is great, right? It meets our 10% minimum, so that's great. But if we're comparing that to their historical growth, it's substantially slower. So as I said, we need to ask why. Why is this the case? And for Facebook, since most of their revenue is generated through advertising, we can look at 2 different factors that influence that overall revenue figure, or most of that revenue figure. One is the amount of users that are on the platform, and then the other is the amount of revenue generated per user. So that's called average revenue per user, ARPU. And if you multiply those two things together, the number of users and then the average revenue per user, you will get the total revenue figure. When advertisers spend more money on Facebook, the average revenue per user goes up. So that's what I was looking for in this quarterly report. And if we take a look at their year-on-year results for the second quarter, so comparing Q2 2020 to Q2 2019, they had the exact same average revenue per user of $7.05. Now, in terms of the number of users, this did still continue to increase, and it increased at an accelerating rate in Q2 of this year as well as Q1. And Mark Zuckerberg and the management team think that this is a result of the lockdowns that have been happening all around the world. More people are staying in at home and communicating with their friends and family online. Now, in terms of Facebook's business, we should expect that user growth will slow to zero over time, right? Because they're reaching a point at which now they have over 3 billion people using at least one of their services every single month, which is, I think it's over a third of the world population is using their platform on a month-by-month basis. So we shouldn't expect much growth from that in the future. Where the growth will come from is advertisers willing to pay more to advertise in front of that Facebook audience, driving up that average revenue per user. And the bottom line in terms of what drove revenue growth or what limited revenue growth in this quarter is really just down to what is happening with this pandemic. The pandemic boosted the number of users on the platform, but the pandemic has done something else that is a much greater factor, which is that it's hurt a substantial amount of businesses which would normally advertise on Facebook. And that pullback in advertising spending is why they didn't grow as fast as they have in the past. So moving on to earnings per share, EPS. EPS came in at $1.80. This was up 98% year over year. So again, it meets our 10% requirement, but we would notice that this 98% increase is substantially different to their typical growth. So we want to understand why. Why did they grow their earnings per share by 98% when typically they've been doing this at 20 to 30%? And if we look in the footnotes of the press release, we can see that the 2019 figure that we are comparing this quarter to has a $2 billion legal expense and a $1.1 billion one-time tax expense. So both of these expenses are one-time expenses. These are things that are not a part of the normal operations of the business. So what I like to do is I like to add back any expenses that are not part of the normal operations and then calculate the growth rate again to see how the normal operations of the business grew. And the easiest and quickest approximation way to do this, and it's maybe not the most accurate way, but it's certainly the quickest and it gives us a good approximation, is to just look at the cash from operations and then add back the legal fee. So when we take a look at income from operations, we don't need to worry about the tax stuff anymore because that's calculated after income from operations, but we still need to add back that $2 billion legal expense to the second quarter of 2019 figure. So once we do that, we see that income from operations actually went down 10% year over year. And if we look on the investor presentation slides for the quarter, we can see that profit margins have been going down over time. And this has been a trend for Facebook recently because they've been spending a lot more money to develop their systems and algorithms around privacy and safety. The positive thing out of this is that in the third and fourth quarters where Facebook makes most of their money, their profit margins should be much higher. That's sort of been how it's been historically. And that's really a result of the fact that they have very little fixed costs. So in the quarters where they have Christmas spending and advertisers spending a lot of money on the platform, their revenues go up, but their expenses do not go up substantially. And as a result, their margins improve and their profits grow at a higher rate than their revenues. So for people like myself who are investing in Facebook for the long term, we are hoping that Facebook is spending a substantial amount of money now to build a a solid foundation of safety and security, and then that spending will stop increasing at some point in the next few years. And as a result, when revenues continue to grow, their profit margins will eventually improve, and that will result in their profits growing substantially after they've stopped increasing their expenses as they have been doing over the past year. The next figure we look at is equity. So equity was $101 billion, and this was up 9.4% year over year. So this is about 10%, which is great. And it is a little bit lower than historically they've been growing at about 20%, but it is still very, very strong. And it is likely that the reason why equity is growing slower is in relation to the fact that they produced less profit and less revenue, as we saw in the other numbers. When I'm looking at the equity figure, I'm not just looking at equity, I'm actually assessing the entire balance sheet. So equity being what is the difference between their total assets and their total liabilities, everything they owe. So I look at that figure at the end, but I'm also having a look at their overall financial position. So I'm looking at their cash, and at the moment they have $58 billion in cash and marketable securities, which is short-term investments, bonds, safe investments, that sort of thing. They have $0 in debt. And then in terms of the two ratios that I like to focus on, the current ratio and the debt to equity ratio, they have a current ratio of 6, which is insanely high, very, very good, and a debt to equity ratio of 0.26, which is again, very, very low, which is very, very good. The thing about Facebook is that their financial position is just outrageously strong to the point where there is no chance that they get in financial trouble, no chance that they go bankrupt anytime soon. And they have so much cash on their balance sheet and short-term investments that could be moved into cash. And both of those can be used to make huge investments in the future. So as their advertising business is going to slow down eventually, it can't grow at double digits forever. They have billions of dollars available to them on the balance sheet, plus cash coming in every single year in order to invest in new industries such as the payments industry, which I think Facebook is probably going to invest more than $100 billion into the payments industry over the next 2 decades, which means that they can establish themselves in that industry and continue to grow the overall company's cash flows. Speaking of cash flows, the cash flow for owners figure for Facebook came in at $2.3 billion, which was down 77% year over year. So again, this is obviously a substantial deviation, so we need to ask why. Why did this happen, and is this a concern for long-term investors? Again, I looked at the footnotes, and what I could find was that they actually paid off that $5 billion fine in April, so that happened during that quarter. So basically what happened is when they got hit with the fine, it came out of the income statement the moment that they got slapped with it, right? That was last year in the second quarter. But in terms of the cash flow statement, that figure hadn't come out yet until they actually paid for that fine, which they did in April. So again, it's a one-time thing, so I'm adding it back. And once you add that back, their cash flow for owners figure actually grew by about 7% during the period. And then the last major thing that I'm looking at when these quarterly results come out is to see how the business's cash flows are going compared to the models that I have in my discounted cash flow. So when I'm investing in a business, I come up with a range of growth that I think this business can produce for its cash flows in the future. And as a result, it tells me what I should expect from their cash flow for owners figure in each of the next 10 years. So I like to compare their trailing 12 months cash flows to what is going to happen, or what my model suggests could happen in the next year, in 2020 in this case. So in my discounted cash flow models, I have an estimate for 2020 cash flow for owners to be somewhere between $32 and $34 billion. So what I do is I want to calculate the cash flow for owners produced by the business over the last 4 quarters, the trailing 12 months, and see how it is going. Is it on track? So basically, the trailing 12 months will be Q1 and 2 of 2020, and then Q3 and 4 of 2019. So I did that calculation, and they're actually on at about $26 billion in cash flow for owners over that period. So that's even slower, or a smaller amount, I should say, than their 2019 figure. So basically, this year so far, the business is underperforming my expectation for how much cash it would produce for me as a shareholder. And the thing to mention is that this is to be expected considering the economic conditions that we're in. And we've seen this across the board in this quarterly report from Facebook in all of their numbers, right? They've grown revenue by 10%, but I would expect them to be growing revenue in normal conditions at a higher rate. So they've underperformed, but that's normal in weak economic conditions. And I would expect when economic conditions are strong again, that they will be outperforming in my models. So besides that, I also go through the conference call and listen to the questions, see if there's anything interesting in there that might add to my understanding of the business or provide a little bit further clarity in terms of my analysis. But besides that, that is the quarterly report for the second quarter 2020 for Facebook. I hope you guys enjoyed it. And if you have any thoughts on Facebook or my analysis or anything like that, then head down to the comment section and let me know your thoughts down there. Leave a like on the video if you enjoyed, and of course hit subscribe if you want to see more content like this. But other than that, I hope you guys have a great day, and I'll see you in the next video.